Welcome everybody to Money in the Tank. This week you've got Arnie and Brad, and the big J-Man is off but not sick. Jolly is not sick. He's just tied up with a lot of work. Other people sick. Big Jolly just covering people. We've got a good episode today. Burry Bonanza that we're going to be talking about. But before we jump into that, Brad, journalist and startup guy, and
Arnie, finance professional.
And Arnie, do you want to subscribe?
Yeah, if you want to get us, it's at Money in the Tank on YouTube, Twitter, Instagram, and Facebook. So please, on the YouTube, like, comment, and subscribe. That helps us and helps the algorithm, and we appreciate all in any interaction. So
all in any interactions. We have fun doing this, and if we can help out anybody while we have fun, why not? Exactly. Every week we have fun. So this week, before we get on to I guess Burry Bonanza.
The big bad Burry Bonanza.
Big bad Burry Bonanza. Which is the topic that Arnie and I thoroughly are going to enjoy. I thought we'll get our Rifkin's rules out of the way and stick to,
got the internet version. The internet
version. No book today.
Jolie's got the Bible in hand.
No Bible in hand. I pulled out three. One of them may have been said before, but hey, look. It's all right covering things that have been covered before. Just reiteration goes. It's good.
We're revisiting a few gems. That's fine.
A few gems. I've got a couple here. One is no person has ever been successful without the help of someone else. Next one's a bit of Rifkin confidence / arrogance. Associate with successful people because some of it is bound to rub off. I always have.
I don't mind it.
I always have.
Yeah, I mean,
it's a little Rifkin gem there. And the last one, which is probably my favorite one that I found, which was there's insider trading going on everywhere in the world, all day, all night, everywhere, and everyone wants it.
Pure alpha, baby. Yeah, he's right.
People said it. I mean, I remember being over in Malaysia with Amy, my wife's dad, who kind of runs a quarry. And, we're talking about over in Malaysia, I guess the way business is done in Asia, and kind of the different bits of the pie that get sliced off as it gets mined, put onto trucks, as it travels through certain roads, as it goes over borders, and etc. And I was like, oh, how do you manage to do business over here? Like, it must be. And he's like, you don't think there's corruption in your country? Here it's just out in the open. In your country, you're just very good at hiding it. And I was like, touche.
I heard a similar story from a mate who built a house in Indonesia, and it was just grease and palms left, right, and center, and got the house built. But and
it's just the way it's done. It's funny because if you think it's not everywhere, then I think you're being a little bit a bit naive. But big bad Burry Bonanza time, man. Oh jeez. So yeah, I'm sorry, mate.
Burry. We're just going to talk about Burry's history a little bit, chronologically, where he's come from, and then his amazing calls, and then Brad's titled off to, I think, we might not. We're going to talk about Big Bad Burry's bad bets, and then Big Bad Burry's good bets, and then talk about the two major predictions he's making for the current market climate, and then just our thoughts on those two predictions that Burry's tabled.
He's definitely someone. Look, the guy struggled big time as he's growing up with, massively on the spectrum with Asperger's. He thinks differently. I'd say that he's, what's that word, Arnie? You described one of our friends. Contrarian.
Oh, contrarian.
He's contrarian. He's generally a bearish kind of, I wouldn't say that he's a optimistically guy, but he looks at the world in a different way, and he's very intelligent and has ways of synthesizing a bunch of data into, I guess, plays or thoughts or predictions, which are very sound. And look, not all of them play off because not all play off. And as Arnie said before, we'll talk about a couple that he's made. One of them in 2019 and one of them more recently. And it might not pay off, but that doesn't. Predicting when it's going to happen is a bit different to predicting what's going to happen.
He might be right. He has said before, famously, I might be early, but I'm not wrong. So we'll see what he says.
Correct. And then there's, the counters to that one. There's people that say that if every single day in the year you yell out there's a market crash, you'll eventually be right. So there is give and all. We here at the Tank, we don't try to blow smoke up people and the rest of it. But we try and show, at least what we think, and then what the other side is.
Yeah.
So a bit about big bad Michael Buzzer or Burry. Buzzer. The guy's an American investor. He's a hedge fund manager and physician. He founded the hedge fund Cyan Capital. Arnie, do you want to quickly talk about? We ran that from 2000 to 2008, I believe.
Yeah, well, I might talk about just the early days before he founded Cyan Capital, because just quickly a little bit of internet history here. Burry was on a very famous value investing website called Value Investors Club, and if you want to go look at it, Tankers, it's still alive and kicking today, and you can earn membership by posting a thesis or two to the Value Investors Club, and then if the existing members of that club like your thesis, they will upvote it, and they might issue you membership. And then to retain membership in the Value Investors Club, you must post at least 2 theses a year, and it can't be done on the drop dead date. You have to be posting them pretty regularly throughout the year, so people can take advantage of your analysis. If you're right,
are you in there, Arnie?
I have perused the forums, but I've never ever submitted a thesis of my own, maybe because it's a little bit daunting. Like, there's some very, very famous investors there. It's anonymous, but there are some very, very famous investors there and institutional investors that are in that club. So
can you read the really quickly? Can you read the forum without being a member? You can't write the thesis.
You can read a lot of the analysis, but the ones that are the current plays that must be submitted every year, you need to be one of the members to read those. You need to
submit 2 theses.
To gain membership, I think you just need 1 that is upvoted by the existing members, but then to retain membership, it's 2 a year. So Burry was a member of this.
I reckon we'll put this challenge to ourselves, Arnie.
Money in the Tank, try and become members.
I reckon Money in the Tank, try and become a part of the Value Investors Club.
Yeah, okay.
And we'll put a 6-month. Let's put a 12-month
challenge
on that one. Challenge.
All right. I like this. Yeah, I like this. This is good. Okay, we'll do that, and then we'll share the thesis with Money in the Tank. All right.
That's what I mean. I've got a lot of time these days.
Yeah. Okay. I've got a few theses I'm working on anyway, so let's do that.
Excellent.
So, anyway, Burry was discovered. I'm not sure about the exact dates, and he was noticed because of his returns were consistently outpacing the market at the time. And then certain members of that Value Investors Club were asking him, basically begging him, if you believe the stories, to start managing some of their money for them. And he eventually, I think he originally said no, but then he eventually acquiesced and said, okay, I'll manage the money. So Cyan Capital, founded in 2000, just around the time of the dot-com bubble, which was 2001, obviously, 2001. And he attracted the attention of big name investors, most notably Joel Greenblatt, who is one of the managers of Vanguard Group, or was at the time. And by shorting the big tech companies around that time, he saw something like 55% annualized returns, where the S&P 500 lost 12% in that year, and gained his sort of first bit of major notoriety outside of the Value Investors Club. And then after that, unless you've got anything to add onto that, Brad, the next big thing, which I'm sure most of our listeners would have heard of, is The Big Short, which was, in terms of timing, in 2005, Michael Burry started predicting that the American housing market would collapse. And then he...
Pretty funny on those dates, right? Because, I know one that we're going to talk about later on is kind of, global index ETFs and the bubble around them. He made that in 2019.
Yeah.
So 3 years on and everyone's like, and then, 3 years, 2005, 2008. Eh?
Yeah, that's right. So, Burry, he said 2005 is when he first started making his initial bets. And then late 2007 to 2008 is when the housing crisis unfolded. And then we saw, the contagion with institutions like Bear Stearns, etc. So, anyway, just for the Tankers' knowledge, if you haven't seen The Big Short, it's not a perfectly accurate representation, but it's a good depiction of events. And basically, Michael Burry was trying to find a way where he could take the opposite side of the trade to collateralize debt obligations, which is a fancy word of saying, the banks had been packaging up mortgages of different credit quality, and he had gone through the underlying data and found that specific tranches were at risk, meaning people would be not able to repay their mortgages and default, which would cause a domino effect up the chain.
The problem was they were being rated the way that they were being, I guess, weighted when you package thousands of these things. The way they're being rated by rating houses is they're being rated as AAA.
AAA, so whereas a lot of the
showing that less than, I think AAA, can't remember it, but paraphrase, less than 1% of the underlying mortgages were going to fail, whereas he went through line item by line item and realised it was more like in some cases like 20-30% in these package CDOs. So.
That's right. And so he basically got the big investment banks to take on credit default swaps, and he took the other side of that bet. And basically in 2007, he was proven right. And for his investors, he made over $800 million on that trade, basically cementing him as a legend of the financial markets and someone who understands macro very, very well. So I should mention that up in the lead up to him being proven right, he was put under immense pressure and scrutiny from his investors. A lot of them asking to take their money out, and he basically said, like, at this point, I cannot. It is tied up in the trade, and it's happening.
And as per Sign Capital Hedge Fund, basically sign-up rules, I am the only one. I have the power, basically. Yeah. And so he held on, and he was under huge. I mean, the movie does depict that quite well. But inadvertently made lots of money, felt pretty horrible with the whole financial system, and correct me if I'm wrong, Arnie, pulled the plug after he closed out that trade, just shortly after it.
That's right.
And then sat quietly.
Yeah, and I don't know if he manages anyone's money anymore. Like, Scion Capital does operate now, but there was a long period. How long did he stop for between then and
4 years?
4 years. He didn't manage anyone's money.
Opened back up 2013, his hedge fund, this time called Sign Asset Management.
Yeah.
Filing reports as an exempt reporting advisor, ERA, active in the state of California. He focused a lot of his energy and time at that point in time on water, gold, and farmland, where he said, fresh, clean water cannot be taken for granted, and it is not. Water is political and litigious, and so his big thing was there around kind of obviously some upcoming environmental and probably food security and water security. Then he started filing his 13Fs, which in America, I don't know what actually classifies yourself as a 13F. I know that hedge funds and the rest of it have to, but before he was an exempt reporting advisor, so he didn't have to do it. He only started in 2015. So there must be
I don't know. There must be a size requirement. Like maybe you probably have to be institutional, and you probably have to have a certain size requirement, perhaps.
Or a certain amount of investors. Who knows? People will, irrelevant to what I'm going to say. But fourth quarter of 2015 started filing 13Fs, and what 13Fs are, just for everybody's knowledge. Let's have a look. 13Fs are these really, really sexy table here, everybody. Oof. But basically it shows, for instance, one of the things we're going to talk about today is, where Burry's at and why you see here the value at 3 billion when last quarter was at 200 million and quarter two 2021 it was at 2 billion. But if I click on this one here, I can go in and I can have a look at exactly what at the end of that quarter is the makeup of the hedge fund. So you can see that he's holding some put options against Apple, which is supposedly he's still holding them. I read an article, but I couldn't see that in his latest filing. We'll have a look at it later on. But it goes through it. He's holding Alphabet, he's holding Discovery, he's holding a whole bunch of stuff here. But it basically shows the makeup of that fund at the end of the quarter. It doesn't show you what they've done during the quarter. It just shows you at the end of a quarter what their positions are. Now, when he started showing those, after a few more years, they filed more 13Fs, and it started showing that he started holding, large cap stocks and asset management. So he kind of moved away from kind of water and stuff like that, and started playing in this market. And before I jump through to, we start talking about some of the bets in 2018, Arnie, I can start off with a bit of GameStop.
Yeah.
If you want to follow the Buzzarina or Burry, he goes under the title. Look, he's a bit of a I'd say libertarian, anti-government person. So he does push some political stuff. So ignore that if you're not into politics. But if you're into, he basically posts and he deletes.
Bit of a show pony, Browse, because Cassandra is a reference to
Trojan priestess in Greek mythology.
That's right.
Who was cursed to deliver true prophecies, but never to be believed.
Yeah. Could see the future, but would never be believed.
Yes. And so look, he's a bit, I think that side of Asperger's investment has come out on Twitter, and he's obviously his fame and everything like that. But he believes that he's beaten the algorithm of spam bots by deleting his posts. And And so he said of success a couple of months ago that basically by deleting his things, he hardly gets spammed and bots don't take him and the rest of it. But Arnie did put me onto this one, which would have been great before the show because I had to do a bunch of hunting to try and find deleted tweets, and somehow this didn't come up. But there is a Burry Deleted, at Burry Deleted, and basically every post that he posts, this account has made 20,000 followers by just posting what he posted and archiving it. So you can go back and have a bit of a look-see on this one if you want to follow kind of what he has said. But this is the real Burry account if you want to get the latest and greatest at the time. But without further ado, Arnie, do we want to talk about Wise in the spotlight, or do we want to get there just on the timeline?
The first ever episode that Joel and I did was about the GME short squeeze. And I guess Burry was sort of onto this before, or maybe not before everyone, but one of the very early people who was onto this, because I remember he took a pretty large position back in 2018, 2019, when GameStop was trading at around between $2 and $4 a share. I can't remember exactly right, but it was very low. Yeah. And I remember reading some analysis that Burry did at that point in time where he was saying that even though brick and mortar stores were suffering to online competition, something like 80% of individual GameStop stores across the world, not just in America, because they've got different brand names. Like I think here in Australia, it's called EB Games. He did some individual store analysis. This is how deep Burry goes to see that 80% of them were cash flow positive. He found basically that if you were just to buy that business and get control of it and shut 20% of the stores which were not cash flow positive and were unprofitable, then you had this incredible business on your hands, which was not looking too bad from a financial perspective, had massive short interest, which was over 100% of the float, which was more than any other stock at the time or like we will ever see again.
Yeah, I think he said they had 540 million in cash at the last count. He estimated it could also buy back around, so shut down 20% of stores. It could buy back around 2/3 of its outstanding stock and still have plenty of money to invest in its business. Burry described it as an unprecedented opportunity to pull off perhaps the most consequential and shareholder-friendly buyback in stock market history in elegance and stealth. And then that's when he also came out a bit after that with that quote around over 100% shorted.
Yeah. So at that point in time, what you're talking about, which was, I think, late 2019, he owned $17 million worth of GameStop shares. And as Brad was suggesting, he wrote to the board and said, if you buy back your shares and close these unprofitable stores, you're going to deliver tremendous value to your shareholders. So that was Burry's thesis. He wasn't
3 times, right?
Yeah, three times
on the board.
and instantly. And I think he also said, at that point in time, I don't think he was talking about the Roaring Kitty, deep effing value short, like the short thesis as well. But
I said, I think I've got my notes here, early 2020 endorsements from 2 high-profile investors. Investor Keith Gill on his Roaring Kitty YouTube channel. Sorry, it was 2 high-profile investors plus Roaring Kitty stoked enthusiasm for GameStop and Wall Street Bets.
Yeah, so it was Burry and Ryan Cohen, and Ryan Cohen took a large percentage ownership stake, and Burry still held his, and then Roaring Kitty became popular. And I remember he was actually quoted as saying, like, thanks for ruining my purchase price, Burry, because when Burry's 13F around that point in time, which was 2020, came out, it saw that he'd been accumulating more GameStop and the price jumped from like low 2s to high 4s or whatever. And then the rest is history. Like we know what happened with that. It was incredible short squeeze culminating in January or February 2021, and the price went up to like $450 overnight at one point, and all sorts of brokerages sort of had a bit of kerfuffle and stopped the selling. But Burry netted himself a cool $270 million from that trade.
So, in April 2020, could have made 540, but at the end of the day, who picks the top? And I'll be happy with spending 17 million and walking away with 270.
Absolutely, you would. So just further solidifying his credentials. So,
but it shows that like he didn't even get involved when it started becoming hype. This guy was involved for 3 years before the hype.
Yeah,
that's the.
He saw the thesis. He saw the thesis in the underlying value, regardless of the short interest. It's 2 different theses playing out in one.
Correct.
And he got. I guess I don't know. I don't want to say he got lucky that the short thesis also played out. I feel like he was on a winner anyway, but it just amplified the returns. Let's say that. Yeah. So around the same time, Burry had a pretty, I want to say, infamous interview with Bloomberg where he talked about the fact that he basically said we're in an index bubble. He said with ETFs and passive investing, we are in a bubble which has removed true price discovery from the market. So what does he mean by price discovery? I think he's basically saying that because we've got an enormous amount of inflows, which over time have taken a larger share of the pie than the active management funds. So I think I think in 2013 it was something like 65% of all the money invested in the market was actively managed, and then as of 2018 it was more like 50-50 ETFs and index funds taking a larger share. And now I haven't seen updated figures. Maybe you have, Brad, but I think it's flipped over. So now there's more money as a majority invested in index funds than there are.
It's up to 70%.
It's up to 70%, is it? So that's crazy. But yeah,
depending obviously which country you're in, but
yeah. So basically, he's just saying that if you passively follow an index fund and you're not looking at the value at all, and you simply buy these companies in proportion to the size of the company through the index, then you're removing any requirement to do any underlying analysis on the security, which is what active managers do. So yeah, when Barry's talking about this this passive investing, worldwide pension funds will be buying these indexes in these amounts on a timed basis, and that is going to be seeing inflows after inflow after inflow into these index funds. So I guess he basically was saying that there is a problem because there's a liquidity issue, and what he's talking about with the liquidity issue is, say you've got the S&P 500, which is buying in proportion, and the largest 250 stocks see X amount of volume per day. Barry did an analysis on the bottom 250 of the S&P 500, showing that there's less than 150 million of volume activity during the day, but there's over $3 trillion invested into these passive funds, meaning that there's a disconnect between how much of that stock is actively traded versus how much is invested from an ETF side. So if we were to see a crash, and everyone,
when flows reverse,
when flows reverse, which who knows if it will actually happen, right? Because you've got that passive buying worldwide every time someone gets paid. But I guess what would happen? What would happen if you saw a crash? And he basically described it as a crowded theater. Like the theater is getting more crowded and people are piling in, but the exit remains the same. So if we see a crash in prices, you're not going to be able to get the value that you thought you had in your ETF investment. So maybe I can explain that poorly. Sorry.
No. It's basically, it can get ugly when the flows are reversed. Basically, I think the theater is a perfect example, which is you think you might be able to get out, let's just say, like things start reversing. It can reverse very, very quickly, right? Because there is a lot of people in there at once, and they're going to get the side. So you might not be able to just get yourself, because there will be no one passively. Once the passive investment flips, basically, the amount of active investors that are buying into these things is very low, and you need buyers to match with your seller, right? Because for instance, I'm looking at the moment. I won't go into too much. I'm looking into options at the moment on the Chinese economy and shorting options, right? And one of the ETFs that I found, I'll put forward to, this one's low liquidity, right? So it's one of those things which is, okay, when it starts going and the rest of it, could I actually get my money out? Because once it actually happens, am I going to be able to profit from it? Because am I actually going to be able to find a buyer that wants to buy stuff at the higher price?
Exactly.
That makes sense. So in this case, exactly the same thing. You've got people piling in, right? Just passively. Once it flips and the flows start reversing and the passive buys stop, right? And there's a lot of money in there. Where are you going to pressure? Where's it? It's going to, the sell and buy depths are going to be crazy.
Yeah.
So look, some people say that over, and we'll get to this. Some people say, oh well, ETFs, index funds have continued to generate money over 2020 and 2021 because the market's crazy. But
the other key point I might add about the ETF crisis, which kind of plays into this the current inflation crisis, is that Barry was also concerned that a lot of the buying in ETFs was done on leverage. So when you've got people and institutions leveraging up to buy, they're using borrowed money and they're paying interest on that. And then as we see, I guess maybe I'll hand over to you, Brad, but as we see interest rates go up, if people cannot service their debt, if institutions cannot service their debt, then
selling pressure.
Exactly, because they're going to have to sell those ETFs. And if you get, I guess, a run on the ETFs and everyone's trying to sell all at once to try and cover their leverage positions, unfortunately, you're going to get some people, institutions that are not able to do so and not able to sell at the right price to cover, and then they're going to become bankrupt, and that's just going to cause further liquidation at any price, and it's just a domino effect on the way down. So
correct. And I think that passively side of things, you kicked on my biggest thing about the passive side of things. I mean, that's the risk. My biggest thing on the passive side of things is we just keep pumping money into companies without much due diligence because people aren't actively investing. They're not actively making a decision on what stocks they're buying. They're just passively following an index.
It might be zombie companies. It might be companies that aren't profitable.
That's the biggest one for me. Is that we're just putting money into stocks and we're consistently increasing and providing bigger and bigger market. The more the money goes in, the bigger market valuations we get for these companies. And some of them aren't worth what they've been brought up to. And when the fall happens, or if it happens in the future, recessions, cyclical, everybody, there will be what goes up must come down. Murphy's Law. When it's going to happen and by how much, who knows? But, it's dangerous in cycles when you're just like passively driving off a cliff. I think what we'll move on to is his next. He did a big play, and the one that I've really, really liked was at the start of 2021. Everyone knows probably I'm a little bit pessimistic on central banks on inflation. Don't need to really go into that too much, and this is why I probably picked this one. But back in January 2021, Michael Burry basically shorted $280 million, shorting the 20-year US bonds on the iShares Treasury ETF.
Mm-hmm.
Okay. And when you, just to quickly explain, when you're shorting a bond, what you want is the yield of that bond to go up, right? I know it sounds crazy. You want the yield to go up because the price of the bond is negatively correlated. So when the yield goes up,
mm-hmm.
the price of the bond goes down because it means there isn't much demand for the bond, right? And that, therefore, you profit because your yield's going up, but you've shorted it, right? At the time that he bought in January, the 20-year bond was paying 2.3% yield. A couple months later, inflation was about 4%. So what was happening was if you bought that bond, it was paying 2.3%, and you're locked in each year, and inflation's 4%, 4 minus 2.3, you're losing 1.7.
Negative returns.
Negative returns, right?
On the coupon.
So I'll quickly just share.
Yeah, it's all good. I might just say, like, what Brad's talking about is, just for further context, as the yields rise, it means that the new bonds that are sold, which obviously the American treasuries have been sold, in great amounts over the last couple of years, means that you're going to get that high yield, and people who held the existing bond have still got the lower yield, which means that to compensate, they're willing to sell that bond at face value for a lower price. That's sort of how the mechanism works. So what Brad means by inverse correlation is, as yields rise, the price of existing bonds goes down to make them still attractive to buyers to sell.
100%. And I realized why my Yahoo it's under maintenance. So I'm just going to share a different one, which I mean it's still going to show the same story. But we have all the way back here is the 20-year Treasury, and as you can see, if he held the entire time, he would be a pretty penny. But he got out 6 months later. So he got in 2021. Somewhere around here, and he got out somewhere in Q3. But on this trade, because he predicted what was happening with inflation, what impact it was going to have on the yield of the treasury bonds, what it going to have on the demand, and therefore the price go down. He made 17% in 6 months. And so it's one of those trades that I think it shows that he understands where they are in the market. He understands where he thinks inflation is going. He's there going, okay, the cash rate's going to go up, yields are going to go up. He has to create demand for products. He understands what tools to utilize. And that for me is like just a clean bet that basically anyone can make. Because some of those CDO bets and the rest of it, you have to be a specific investor with access to investment banks with minimum bet sizes of 50 million, etc., etc., etc. Shorting some of these ETFs, you don't. So I think that's just a clean way that, where you follow like an economic kind of where the economy is going and what you think's happening, and kind of can profit from it. And so I wanted to share that one and just kind of explain that one. Should we move on to this, the current?
Yeah. So like, I guess just it's sort of furthering on from that initial index ETF bubble thesis. We can now talk about how Burry is talking about how he's thinking about how the current market circumstances, including inflation, but also, I guess, increased activity from like retail investors and how they're using options in the market, how that's fueling his, I guess, how it's expanding his thesis.
Yeah, I mean, I'll probably just quickly say, Burry's been in the news the last couple of days. He's just, as I was showing you before, his filings, he's basically sold down everything inside his portfolio except for Geo Group, which is a prison company in the US, which climbed 13% that one day because everyone's like, oh, he's just holding
Bit
Geo,
grim. Bit grim.
Big Grim only holding a prison company in the US, private prison company. But he's only holding 3 million. I mean, 3 million, I'm not saying only because 3 million would be a huge sum of money to us. But in terms of, 12 months ago, he's holding $2 billion in his fund.
Yeah.
Last quarter, he's holding 200 million. 3 million is quite small. And he's kind of just sitting in cash. And I guess like there's two tweets that I just wanted to quickly show, which is the Nasdaq is now at 23% off its low. Congratulations. We now have the average bear market rally across 26 bear market rallies from 1929 and 1932 and 2000 and 2002. The average is 23%. 23%. After 2000, there were two 40% bear market rallies and one 50% bear market rally before the market bottomed out. His other one is this one, this is not Michael Burry, by the way, everybody. This is Michael Burry up here. This guy is off Bloomberg. This supply gut at retail is the bullwhip effect. Google it, worth understanding for your investing endeavors. Deflationary pulses from this lead to disinflation in CPI later this year, leads to Fed reverses itself on rates and QT equals cycles. Now, we talked about this.
Yeah.
I think either on the last show or the show before about what we think is going to happen.
Well,
and one part of that was, and I think, Arnie, you and I actually agreed on this, if the Fed stops being hawkish on inflation and stops and thinks, okay, we've got a stall in inflation or a deflationary environment, and stops rate rises, then what we'll see is this mixture again and another bullwhip. Now, I'm going to just quickly show the bullwhip. Wait 1 second. Here we are.
Yeah.
In terms of, it's like a whip, a bullwhip, I might even say. And it's small changes in demand lead, and then the planning, then the buying of manufacturers, and it leads to suppliers and the whip-like effect upstream. So I thought this one kind of, for me, best describe the bullwhip effect, which is the bullwhip effect in supply chains. Distorted information from one end of the supply chain, consumers, to the other end, through manufacturers to suppliers, can lead to tremendous inefficiencies, excessive inventory investment, which we've just seen because we've got the highest inventory in a long time at the moment. Poor customer service. I myself bought a wall shelving unit back in May. It was supposed to get delivered by July. Then I got an email saying August. I went to cancel it. I had to pay a 25% restocking fee. I then went online, bought another one. It was supposed to be August. Then it was September. And now I've got an email end of October. So that's, poor customer service. Loss in revenues, misguided capacity plans, ineffective transportation, and missed production schedules. And so I think it's an interesting concept to understand.
Would you mind bringing that back up, Brad? Can you show that bullwhip effect again? Because what I'll do is I'll just talk through what Brad said just then is exactly correct. But if we show that graphic with the bullwhip, just for our listeners who are not watching, if you can imagine when you crack a whip initially, you get a small ripple at the end of the whip, and then as it lengthens out along the whip, the peaks and troughs of those curves extend upward and downward. So if we just talk about a very simplistic example of what Brad's talking about with supply glut inventories, say you've got someone who wants coffee and a consumer wants coffee. So he goes to the supermarket, but there isn't as much coffee there. Or maybe everyone wants coffee. So everyone buys a bit and then they sell out. So that supermarket puts an order into the manufacturer of coffee or the roasters of coffee, and they say, well, hang on a minute, we're seeing a massive demand increase from the supermarkets here. We better get some, from our growers, we better order a bit more so that we can compensate just in case we can continue to see this increased demand. If that makes sense. So you've got, I think I might have explained that pretty poorly, but you've got consumers, grocery, supermarket, then you've got the roasters, and then you've got the actual suppliers or the growers. And then at each stage of that supply chain, people are increasing how much they're ordering. So the supermarkets are ordering more from the roasters are ordering more from their growers, etc. And that's how the bullwhip effect is described. And then what it means is that if demand drops off or doesn't continue at those increasing levels that orders are being placed, then you have a glut in inventories, which will cause disinflation, meaning they're going to try and sell that coffee potentially at a loss to the end consumer because it's going to be very, very cheap, and they need to move that product. So what Barry's saying is that we're now seeing that effect across multiple industries and multiple supply chains. And he thinks the Fed, or he's worried that the Fed will misinterpret that data, that disinflation data, and then pivot, and instead of raise rates, ease and maybe lower rates and stop as much quantitative tightening, which will then in turn cause more inflation problems, perhaps.
Well, there's actually a number of people out there that state that the worst case scenario is that the Fed flip flops, and you've even got what's my favorite guy out of Singapore, what's his name, Al Arian. I'm sure you follow him, Arnie.
On Twitter, no, but I've definitely heard of him.
You'd know, like, if I share again, I'm gonna share the screen. This guy, you ever see this guy around? Everybody,
iconic, yeah.
He is like, literally an absolute boss. But he's the one that also said, "I'm fine as long as the Fed stays hawkish and just controls inflation."
Yeah.
If they try and focus on and think that they've got it under control in the next 6 to 9 months, the worst case scenario is if they flip flop. And Barry's basically, this bullwhip effect is, it's just going to keep this cycle going, and that's why it's gone all cash, right? To kind of, I guess, summarize, the ETF's one part of it, the supply chain's one part of it, the bullwhip's one part of it, the Fed kind of flip-flopping maybe is one part of it. Because, for instance, the ETF one, what could trigger this thing is if the Fed flip-flops, the bullwhip takes effect, it ends up creating a recession, right, and kills the markets, because the markets get disenfranchised with what the Fed's doing, right? The reason why the market responded so well, I would say the last couple of months to even increases, is because the Fed put out well in advance notes. The market's been aching for interest rate rises, right? It's needing it to get inflation control. If the Fed then loses face and credibility, you will see the markets respond. And you will then see, like we're talking about before, the ETF fund people start running on it. And there's a lot of, I guess, different storms at play, right?
And just to add to that summary, because I 100% agree with everything you said. It's hard to conceptualize it from everything we've talked about to the current day, but it's basically, like Brad said, market on a knife's edge. Over the last 2 years, not just in America, but in a lot of the Western world, we've seen enormous amounts of money printing or quantitative easing. And that money has flowed into
$8 trillion in the US, for instance.
Yeah, which I think it's like half the amount ever printed.
40%.
40% in the last 2 years. So a lot of that money is flowing into investments or businesses. And
property.
And as we were mentioning, the ETFs, passive investments, it's also flowing there. And on top of that, you've got the leverage and you've got the speculative investors. So with the rise of meme stocks and Wall Street bets, you're seeing very, very risky bond messages at play here. Sorry, not to say very, very risky bets on out of the money options. Sorry, not bonds. I don't know why I said bonds. And then, as Brad was suggesting, we've got just that inflationary effects. And if we see a pivot from the Fed at the wrong time, it's just going to compound all of those issues. So that's it in a nutshell.
Correct. And look, there is still a chance if the Fed stays, in my opinion, if the Fed, and a lot of people like this guy, Mohammed and Barry, if the Fed stays on course, there will be, there'll be hurt in the economy. But there is a chance for a soft-ish landing. Not everything just to kind of, there is a chance for a soft-ish landing.
Fingers crossed they don't pivot,
Fingers crossed they don't pivot, right? Because at least that's kind of, everyone's expecting this and people can plan for it. As long as people can plan for stuff, things never go as bad. It's when these credibility loss, unplanned, stuff's not going the way that the market wants. That's when you kind of see a bit of a thing. But look, Michael Burry, bit of a childhood story all the way through. His plays, kind of some of his biggest plays and thoughts, and why I guess both Arnie and I follow him.
Well, his credibility speaks for itself. If he says something, you sit up and you take notice.
Anyway, you sit up and take notice. Doesn't mean you have to act. Just sit up and take notice.
What I'm going to do, Brad. Before we do 50-50, I got a few quick rapid fires and then I got a 50-50 for you. So I know we're a bit time constrained, so I'm going to smash these and then ask you 50-50.
Smash it out.
Here's rapid fire news items. Elon Musk tweeted the other day that he was going to buy Manchester United. And then a couple of hours later, he wound back and said, I was just joking, everyone. And in the meantime, the price of the stock went from like $12 to like $15. And I don't know if it's actually come off all the way yet. So we've always got to include that. But then in response to that, a British billionaire, Jim Ratcliffe, said that he wants to buy a stake in Manchester United. And the largest holders of that public stock at the moment is the Glazer family. That stock currently trades for a 2 billion market cap, and they said they're not selling their stake for less than 4 billion. And I think they only own like 10% of it. So there's a whole raft of
Elon's made it in. I love it.
He makes it in every week, mate.
Because he likes to, you know why? Because he loves being in the news.
Oh yeah, he for sure does. And it just, I mean, I'm a bit of an Elon fanboy, but it reeks of like after the fact trying to win an argument with the SEC or with something to do with the Twitter deal, because it's like, oh, I always make these jokes about buying companies on Twitter.
I was just thinking that, which is like, is this literally just like a bit of a ha 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 and showing that in the court case it's going to be happening?
I think so.
I do this all the time, which is not relevant to Twitter since he put a formal offer through. Anyway,
one student has made $110 million trading his favorite meme stock, Bed Bath & Beyond.
How much?
And then $110 million this student has made trading options on Bed Bath & Beyond. Ryan Cohen Ventures of GME infamy has also filed Form 144, so he will have the ability to sell his 9.45 million Bed Bath & Beyond shares, and he's also got out of the money call contracts. A code within the Netflix app, it shows a lack of downloading for the ad tier supported Netflix where it's being tested. And in addition to that, the ad supported plan will block downloads of shows, so you can't have the download function or feature if you're on the ad-supported plan of the Netflix app. And that's the rapid fire news. And then quickly, unless you've got something
Netflix,
to add to
what a dud stock at the moment.
I don't know if it is. I haven't valued it.
You think it's oversold?
I think it's the market cap's around 110 billion. That's still enormous. But for the amount of money they pump into,
huge.
Yeah, that's the problem with Netflix is they finance all their new content with debt, and they have done so forever. So,
and look, debt as a private company, you're not diluting. It's good, but like,
I'll just quickly say,
I
know we're pushed for time, but I'll just quickly say that if their strategy pays off, where they can debt finance or finance through free cash flow, new content. That new content is super popular, drives subscriptions, and then they can amortize and depreciate that over certain amount of time, like 4 or 5 years, and keep benefiting from it. Maybe they're geniuses and we're not, and it's fairly valued. But anyway,
look, these things always play out, right? And you just go, I didn't know that. I thought it wasn't going to happen.
You never know.
50-50, Yanni.
50-50.
Thanks for the news.
When you are making a hamburger at home,
we made hamburgers last night at Andy's, so this is
okay.
pertinent.
I didn't know that. Relevant. Are you more of a traditionalist where you just want meat and seasoning and nothing in the burger, or do you add things like egg, breadcrumbs, Worcestershire sauce? What's your 50-50, bro? When you make a burger, how do you go about the process?
Smash burger, just meat, man. Just
meat and seasoning?
Meat and seasonings, and then put it in, smash it down. Yep, no. I mean, there's obviously other things inside the milk bun, because I'm a milk bun kind of guy.
Yeah, when you do
not a brioche, milk buns all the way.
I don't mean put in the burger itself. I mean in the actual meat.
Yeah, you mean in the meat patty? No, mate. Seasoning, meat, that's it. A good mixture of at least 70-30. So you get that kind of the fat in the thing, and then smash. Just basically the standard old smash burger. Dump it as a ball on the grill.
I love a smash burger, but I prefer, and this is why we do 50-50, folks, it's just to highlight that there's different choices and different preferences out there as there are in investment. I like, when I make a burger, to include, if I'm doing 500 grams of mince, I will do 1 egg, Worcestershire sauce.
Onion?
No onion. I have done it in the past. I've done it.
But originally there was breadcrumbs, there was onion, the Worcestershire sauce, there was an egg in there.
Yeah, I've done that.
That was that. And then I was a blue cheese hamburger fan for a while.
Ooh.
There was the smash burger with a bit of blue cheese in the middle, wrap it up in a ball, put it down, and when you bite into it, you get a bit of blue cheese. Or
that sounds awesome, actually. I would like that.
And then I've just become a simpleton.
I don't know. I go through moods as well, but I think my ultimate is 1 egg, Worcestershire sauce, and then cooking it. Anyway,
but good. Again, if you asked me this question 4 years ago, you would have heard a different answer. And that's the other thing that happens. The investment choices change. Hope you've enjoyed the Big Bad Barry Bonanza with Barney and Brad. I wish your name started with B because we just could have kept going. I'll call you Barney.
Barney. The Big Bad Barry Bonanza with Brad and Barney.
Exactly. Bang.
And if you want to get us at Rain the Tank, YouTube, Twitter, Instagram, Facebook, thanks for joining in, guys.
Thanks, guys. Have a good one. Till next time.